Hello there. Thank you for joining us today. As you're coming in the webinar room, I want to welcome you. My name is Marcia Butler, and I am the webinar director here at Advice Chaser. Before we introduce our guest and get started, I do need to do a bit of legal housekeeping. Advice Chaser, the host of this webinar, is not a registered investment advisor. We cannot and do not give financial advice. Today's presentation is for educational purposes only and cannot be considered advice for any person's individual situation. Advice Chaser regularly hosts informative webinars such as this one, featuring a variety of knowledgeable professionals, many of whom are licensed advisors. Any opinions, ideas, jokes, or principles expressed by presenters are their own, and however true, funny, or interesting, are not endorsed by Advice Chaser. Please do not act on the information you hear today without consulting a qualified financial professional. We're thrilled to bring you today's educational presentation, and here's a couple of housekeeping notes for our attendees. You are muted, but we do encourage you to ask questions using the chat box, and the presenter will answer those queries today during or after the webinar as appropriate. If you ask a question in the chat box, go ahead and leave your phone number as well. And if we can't get to your question during today's event, we'll make sure to have someone reach out to you afterwards. We want this experience to be as educational as possible. So again, please don't hesitate to ask for clarification or expansion of the material. Well, Wade, why don't you go ahead and move us to the next slide here. And again, please feel free to ask questions in the chat. That chat box should be located at the bottom of your screen. I'm going to go ahead and introduce our presenter today. Wade Slum is the president and founder of Sedoxia Capital Management, LLC, which he founded in Newport Beach, California during 2007. Wade has worked in the investment industry since 1993 and has been a media go-to resource as seen on CNBC and ABC News. He's also been quoted in the Wall Street Journal, USA Today, New York Times, Dow Jones, Investors Business Daily, Bloomberg, Smart Money, among other media publications. And I'm very excited to have you here today, Wade. I'm going to go ahead and turn over the time to you.
Great. Well, thank you very much, Marcia. I just want to thank you and welcome everyone for attending today. The question that we're tackling today, the top 10 questions to ask when looking for a financial advisor, is very important. For many people, they spend more time planning a vacation than they do researching a financial advisor. So kudos to everyone on today's webinar for prioritizing your finances and your financial future. I know Marcia gave a brief introduction, but for those listeners who are less familiar with my background, I just want to tell you a little bit more about myself. So I founded Sedoxia Capital Management in 2007, but we started operations in 2008. I have over 30 years of experience. I managed a $20 billion fund at American Century. I got my MBA from Cornell University. I have what's called a chartered financial analyst designation, a CFA. I'll talk a little bit more about that later. And I'm also a certified financial planner. As far as Sedoxia goes, we manage money for individuals. I have a hedge fund. We manage retirement plans in the forms of 401ks or pension plans. And I have instructed various classes at UC Irvine, including the Advanced Stock Investments course for the CFP program. And then lastly, I'm a published author. I've written a couple books. You can see here How I Managed 20 Billion and 1001 Truths. And I also have a blog called Investing Caffeine. So that tells you a little bit about myself. If you're interested in learning more about me, you can Google my name, Wade Slum, or look up Sedoxia Capital Management. You should be able to find plenty of information. So with that, let's go ahead and dive into the process of searching for a financial advisor. The first question you want to ask is, how much experience does the advisor have? This is a very important question, especially when it comes to your life savings, your retirement and financial future. And the reason that this question is so essential can be explained with a few examples. So let's say you needed to have brain surgery. Would you want to have a surgeon with 30 years of experience has successfully completed thousands of surgeries? Or would you want a nurse straight out of college with no surgery experience? Or if you were flying a plane through a hurricane, would you want a seasoned 30-year veteran pilot? Or would you want a flight attendant to land the plane? I believe the answer will always be the same. You will always want the professional with the most experience. I've been investing in the financial planning industry and investment industry for decades, and the same principle applies to our industry. So it's important to remember experience does matter. Our next question is also associated with experience, and it relates to what education and credentials does the advisor have. Typically, in other industries, there are strict, rigorous guidelines and requirements to operate as a professional. For instance, if you want to become a doctor, you need to graduate from medical school. If you want to become an attorney, you need to graduate from law school. If you want to become a professional accountant, you need to pass the CPA exam. Well, that's not the case in the investment and financial planning industries. The hurdle is much lower and less stringent. So basically, if you can pass a 2-hour exam, you can get licensed to manage, oversee, and invest in individuals or whole families' critical life savings without much, if any, oversight. As you can see from this slide, there's a virtual alphabet soup of credentials and designations out there in the financial advisor world. I like to call this a credential shell game, where an advisor tries to trick you and make you pay attention to a bunch of fancy sounding titles. For example, some advisors call themselves an AWMA, Accredited Wealth Management Advisor, or a CIMC, Certified Investment Management Consultant, or maybe an AAMS, Accredited Asset Management Specialist. Most of these titles I have never heard of. I've been doing this for over 30 years. There are literally dozens of these, what many consider meaningless credentials. And from my perspective, these letters are worth less than the value of the paper on the business cards. It's important to remember, although not all credentials are created equal. So there are, however, a few credentials that are meaningful and valuable. Unlike most other professional industries, the most rigorous credentials used by financial advisors are completed on a voluntary basis. As I mentioned in my introduction, I have what's called the CFA, or Chartered Financial Analyst designation. The way I like to describe this credential is an inch wide and a mile deep in the subject of investments. Just to put it in perspective, less than a few percent of advisors out there have this credential. I also have the CFP certification, Certified Financial Planner, which is more like a mile wide and an inch deep, covering disciplines across a wide spectrum of areas, including investing, estate planning, insurance, taxes, and financial planning. Both of these programs and designations take years of studies and require years of industry experience before the governing bodies grant the use of these letters to the advisor. As I said earlier, taking the test and setting the rigorous curriculum are completely voluntary. So finding advisors that have achieved these credentials is a sign of dedication and commitment to the industry. And lastly, besides financial advisor credentials, education is important as well. It's important to find out if the advisor has earned a degree, where they studied, and what they studied. I mentioned earlier, I earned an MBA from Cornell, but I also got an undergraduate degree at UCLA in economics. And my clients can gain some comfort that I didn't just come into my role straight off the streets without training. The next important question that you want to ask your advisor is, are they willing to spend the time to educate you? You know, clients and prospects, they're spending a lot of their hard-earned money to hire an advisor. So you really want to make sure that the advisor's patient enough to educate you. If you don't really know what you're invested in, you're not going to sleep well at night. And that's what our job is as an advisor, is to make sure our clients understand our strategies, that we educate them, and that they can sleep well at night. And so please don't be bashful to make sure that your advisor is willing to do that. So another critical question to ask your advisor is whether they are a fiduciary, because there are inherent conflicts of interest in the industry. And why is this an important question? Well, advisors who are fiduciaries are required by law to do what's in the best interest of clients. This isn't the case for most advisors in the industry. The predominant standard in the industry is the so-called suitability standard. This lower suitability standard applies to probably most of the large financial institutions that you've heard of. Firms like UBS, Merrill Lynch, Wells Fargo, Edward Jones, Morgan Stanley, a bunch of others. What the suitability standard basically means is that the advisor just has to do what's suitable or good enough for a client. I like to call this the McDonald's standard. McDonald's food isn't necessarily the healthiest, tastiest, or best value, but it's considered good enough. An example of this conflict of interest could be a proprietary product sold by an advisor to a client that is more expensive and may have higher risk, but the advisor may make more money because his employer pays the advisor a higher commission. So in other words, the advisor has an incentive to sell substandard investments to their clients when better and cheaper alternatives are available. Another example would be things like high cost and complex annuities. This is fertile ground for potential conflicts of interest, where the advisor can overcharge a client and for a product that could be replaced with a cheaper and better product in many instances. All right, moving on. How does advisor get paid is another vital question to ask. Unfortunately, advisor compensation structures and the cost of investment products are very opaque. The financial industry isn't known for its transparency, which is why it behooves you to ask how the advisor gets paid and what are the costs of the investments they are using. It's regrettable that much of the compensation and fees in the industry are buried in the small print. My firm, Sedoxia, is known as what's called a fee-only advisor, which means we generally charge a flat percentage of assets we manage, for example, 1%. The reason this is important is if the value of our clients' investments go down, then we get paid less, and vice versa. So if asset values go up, it's a win-win for the client and advisor. Under this fee-only structure, the incentive is for the advisor to grow and preserve the assets. So by being a fee-only advisor, this mitigates the conflict of interest between the advisor and client. All right, next. Does the advisor eat their own cooking? As we described earlier, there can be many conflicts of interest in the financial advisory world, and too many times advisors do not invest in the investments they are selling or providing to their clients. Commissions can often be the #1 motivation for the advisor, rather than what is best for the client's financial future. If offered a new investment product, one way to cut to the chase is by asking, "Oh, that's great. You will make an immediate $10,000 commission off the sale of this product to me, but do you own the same investment in your personal portfolio?" If the answer is no from the advisor, that's a good sign that you should probably be running for the hills. You would much rather find an advisor who has skin in the game. So, for example, at my firm, we are invested in what our clients are invested in, or in other words, all our clients are offered the same menu of investments, and all our employees invest in their personal accounts from the same menu that we offer to our clients. All right. Another crucial question to ask is, does the advisor have any blemishes on their record? There are a lot of financial sharks out there looking to feed off of weak prey. So it's important to do your due diligence and research on the background of the advisor you are looking to partner up with. You can ask, what organizations the professional is regulated by, and contact these groups to conduct a background check. Your best resource for this will likely be a website called BrokerCheck, which is regulated by FINRA, and FINRA stands for Financial Industry Regulation Authority. And the website can be located at BrokerCheck, one word, .finra.org. Okay, moving on. Another essential question to answer is, what does the advisor's clients have to say? It certainly doesn't hurt to ask the advisor, can I get some client references? That way you can hear directly from other clients what they have to say about the advisor. Now, you're probably going to be fully aware that you're not going to receive, or unlikely to receive, bad references, but you will be able to find out, how long have the reference clients been working with the advisor, and you'll also be able to decipher just how positive or neutral their experience has been with that advisor. All right, in winding down, getting down to our last few key questions to ask. How many clients does the advisor have? It's, it may or may not be a surprise to many, but some advisors attempt to service literally hundreds of clients. And not too surprisingly, the highest revenue generating clients are often given better service, and the smaller accounts are treated in many cases like chopped liver, or swept under the rug. And there are several ways you can get a sense without getting a direct answer for the number of clients. And you can get a good indication from your early interactions with the advisor. How quickly do they get back to you can determine how overworked or lazy the advisor could be. You want to get positive response to questions like, how responsive is the advisor to your inquiries? How attentive, patient, and detailed are they in their responses to your questions? How much time does the advisor devote to you during the early interview process? We have all been to those 2-minute doctor visits where you're forced to wait in the waiting room for an hour and then you're just rushed in and out. Nobody likes to be treated that way when it comes to your financial well-being. Okay, last but not least, it's nice to know, does your advisor have a track record? So one of the ways I like to describe this is if you were in the market to buy a racehorse, before you forked out a large pile of money, you're likely going to want to know what the track record of that racehorse has been. How has it performed in previous races? And again, the same principle applies to your financial advisor. So if the advisor doesn't have a formal track record, you could ask the advisor for some sample client portfolio information, and the advisor could always redact personal information. So yeah, at Sedoxia, my firm, we do have composites and historical information for our different strategies, whether they're conservative, moderate, or aggressive. And you know, like I said, we've been in business for over 15 years, and we can provide that track record to our clients. So with that, I think I could turn it back over to Marche, and we can see if we have any questions.
All right, we do have some questions here. And so I will go ahead and start, and we'll see how many we can get through here. So this is a good question. I've heard about an investment thesis or an investment philosophy. How does that play into choosing an advisor?
Yeah, I think that's a great question. The way I like to talk about the investment world is like religion. If you talk to 10 different advisors, you're going to get 10 different philosophies or 10 different strategies. I think what's most important and what we try to do with our clients is to explain what we do in terms that they understand. Because like I say, when I go to the auto mechanic, they use lots of terms that I have no clue what's going on. And it is largely a trust-based business. But the way we like to treat our clients is to explain it in terms that they understand. So, you know, our philosophy, you know, at our firm is low cost, tax efficient, long-term time horizon. And we go through the nuts and bolts of that with our prospects and clients so that they understand and why we believe that leads to better results. But ultimately, when you're talking about philosophy and strategies, the proof is in the pudding. And that's where we get back to the track record and, you know, talking to other clients to see, you know, what their experience has been.
All right. So you talked about the suitability versus the fiduciary standard. How does someone find out whether or not they're working with someone who is doing, you know, has a fiduciary standard?
Yeah, I mean, the short answer is to ask directly, are you a fiduciary? And if there's any hesitation or pause, then you can be a little hesitant and skeptical. You can directly ask them, you know, could you send me some documentation or literature? Get it in writing. Could you, you know, respond to my email and confirm that you are a fiduciary? And, you know, it could be fairly easy to find out. But, you know, we all lived through the financial crisis in 2008. And this issue became front and center. And as you can imagine, a lot of these large financial institutions went scratching and screaming when the regulators said, hey, if all the advisors and professionals in the financial industry were fiduciaries, we could have avoided a lot of what happened in 2008. And it was debated for years of requiring all advisors to be fiduciaries, but ultimately, you know, the lobbyists and the big financial institutions won, and it's that issue of a mandatory fiduciary duty has been tabled for the time being.
All right, here's another question. Talking about assets under management, what's your opinion on hourly based advisor charges instead of percentage of assets under management?
Yes, I think that's perfectly appropriate for certain individuals and cases. So I would say it's dependent on, you know, how much time and effort is put into doing it. So that question can relate to a lot of people want to do it themselves. You know, when they're remodeling their kitchen or doing work in the garage, you know, they may enjoy doing that. Some people like to do their own taxes. A lot of people don't. They want to outsource it. So when you're talking about an hourly rate, our firm, for example, we do that more on the financial planning side. If we're going to work with somebody, if they're looking to budget or get advice or do consultant work for clients. But as far as hourly work for investments, I think it just really depends on the relationship between the client and advisor, how many hours of work are necessary. And, you know, I'm not too familiar with people doing investments that way, but yeah, you certainly could charge on a flat fee on a quarterly basis, and I think that would totally be reasonable. So I think I'm not real familiar with advisors doing that, but I think that's certainly a valid way of approaching it.
This one is about speaking about fees again. Some advisors do get commissions from, like, say, insurance products that they have their clients, they recommend to their clients. What about advisors who are who offer who get a commission but offer maybe a wide range of insurance products, so they're not necessarily compensated for selling this particular product?
Yes, so the insurance industry and the products that are offered are gargantuan in number. And, you know, I mentioned briefly annuities. If you were to pick up you know, they call it a prospectus, it's a legal document describing the ins and outs, the intricacies, the nuts and bolts of an annuity. In many cases, they're hundreds of pages long, so very complex. And so generally speaking, a lot of these insurance products, as it relates to investing, are higher cost and higher fee. Now, I don't want to say that all insurance products are bad, because that's not the case. However, in many instances, you can substitute and replace other cheaper, just as good, if not better, investment products that can accomplish a lot of the goals that are embedded in these insurance products. So I think when you're working with an advisor, again, it just requires to ask a lot of questions, make sure that you understand what's trying to be accomplished with these insurance products. Typically, and especially last year in 2022, when the market was down, not only for stocks, but for bonds also, a lot of these insurance products are designed to hedge or protect on the downside. And again, we don't have a problem with that. Our only beef is that you can replicate that with less expensive hedging products, or derivatives like options and other ways of hedging.
All right, so you're saying there's other ways to do it than just one particular insurance product, many ways to solve that problem.
Correct.
All right. This is another great question. I've been to advisors that suggest investment ideas that really have no idea how to evaluate. What kind of questions do you ask in order to assess the risks that these type of investments are? And this person also gave an example. Thank you, by the way. I'm comfortable in investing. For example, I'm comfortable in investing in highly rated bonds, yet not comfortable in being in a bond fund. Can you maybe talk to this example? What questions do you ask to figure out what type of investments, what the risks are about those investments?
Yeah, no, it's a very good question. It's, can be complicated and layered and can go in a lot of different directions, but fundamentally, they're embedded in the question is, how do I approach an individual investment versus an investment in a fund? And in a fund, you can think of as a basket of individual investments versus an individual investment. So just by definition, a fund is going to be more diversified. And so it'll kind of cushion the volatility of whatever asset class that fund is in. And so if you're going to evaluate or research a fund, I would point the listeners to resources like morningstar.com, where you can simply type in the ticker symbol and you can evaluate the individual investments that are in there. You can look at the volatility of the fund. You can look at the track record. And then you can get more detailed research by going directly to the sponsoring company, the company that's created the fund. And they'll have what I mentioned earlier, like a prospectus. So it's a legal document. It can be good to, go to sleep at night because there's a lot of legalese embedded. But there's a lot of valuable nuggets and information in there if you have the time, patience, and interest to go through. So that's on the fund side. On the individual side, that's a little bit more complex, but that's what I love. And what I've been doing for 30 years is investing in individual companies' investments, whether it's an individual stock or an individual bond. And that would be a topic for a whole new webinar, but I'll try to boil it down into Reader's Digest version. Some of the things that we would point an individual to look at would be things like the profitability of a company. So we don't advise clients to spend a lot of time speculating in money-losing companies. That doesn't mean you can't make money. Just like if you go to Vegas, you can try risky strategies and invest in risky strategies and make money. But yeah, we're looking for things like cash flow and balance sheets, stable companies, stable financial positions. We're looking at the industry and the growth prospects. We're looking at the management of the company. So there's a whole host of criteria that we look at in individual investments. And although it's a great question, it requires a lot more detail if you're going to do that on your own.
Well, speaking about that, what do you feel is the role of an advisor to educate their client about their investments?
Yeah, I think it's vitally important to educate your clients because, as an advisor, a lot of what I consider my role is to allow my clients to sleep at night. And there's going to be a lot of volatility, and we've seen it in recent years, and it's going to be in future years as well. And from my perspective, the client's always going to feel more comfortable if they can understand what they're invested in and what the strategy is. In order for that to take place, you're going to need to educate the client. So I think it's vitally important. And it gets back to kind of the education and credentials of the advisor, because in many cases, as I indicated before, this is a largely sales-driven industry, and a lot of these advisors are very eloquent and articulate. But again, from my standpoint, there are a lot of advisors out there that don't really understand what they are selling to their clients. And although they may sound like they know what they're talking about, until you ask them a lot of questions and get educated on what is actually embedded in the products, you're gonna, in my view, get a lot of hesitation from the advisor, because in many cases they don't know what they're selling.
All right, we have time for a couple more questions. Can you talk about difference between SEC registered versus non-registered advisors? I'm not really familiar with that term, but maybe you could talk to that.
Yes. So SEC registered investment advisors, it's been a kind of a moving target over the time that I've been in the industry. It used to be a much lower threshold. Today, it's 100 million in assets under management requires you to be SEC registered. So for firms that are smaller than that, then they're registered by the state. And so the state largely follows the same rules and regulations as the SEC, the Security and Exchange Commission. So they're the national regulator. You can think of them as the national police force, and they look over all the large financial institutions. And then the states, they follow suit. But as far as advisors go, yes, in order to manage money for an individual, they have to be registered, at a minimum with the state, and get their Series 65 or Series 7 or whatever the requirements are. They need to be registered that way to manage money for individuals.
All right, and we're going to end this here. I know we have more questions that we can probably answer, and I have saved this information, folks. So if you didn't get your question answered, I will talk with Wade afterwards, and we'll try to write those down and send you an email to get that information out. But here's the question: how can you check if an advisory firm eats their own cooking, as you said in the slideshow?
Yeah, that's not really a regulated response required by businesses. So again, I think that similar to the fiduciary question, a lot of these questions you just need to directly ask, and you can ask them, for examples, what are you personally invested in, and basically have to hold the advisor's feet to the fire. I mean, you can't. People often, or investors, feel intimidated to ask questions for things they don't understand. And you look at things like Bernie Madoff. He ran these, this Ponzi scheme for years and years and years. When investors ask questions, in many cases, he just got rid of them. He said, okay, you're not going to be a client. And that's the exact opposite environment that we're trying to create. And, I would just encourage for all these questions to, hold your advisor's feet under the fire. You're paying them a lot of money, hard-earned money, to manage your assets. So, don't feel embarrassed to ask questions. And if they make you feel like those are their dumb questions, or they make you feel badly, I think that's a big red flag.
All right, a good cautionary tale to end on. And we're going to go ahead and close things out. Folks, we want to thank you so much for being here. A little bit of a note, if I'm sure that you might want to review this information again, And so if you will look to your email soon in the next day or so, we will be emailing you out a link to the replay of this event. And you're welcome to share that with friends and family. We want to thank Wade Sloan for being here and being our guest. We're getting a thank you in the chat, by the way. Yes, go ahead and say thank you or any comments about today's webinar. We appreciate that. Here at Advice Chaser, we're all about helping you find a financial advisor who's a great fit for your life and your financial questions. Our matching service is free to you, and every one of our advisor partners has committed to offer a free initial consultation to anyone we introduce them to. Find out more by going to advicechaser.com and clicking on the link to find an advisor. Well, once again from Advice Chaser, thank you so much, everyone, for coming, and we will see you at another webinar soon. Goodbye, everyone.